everyone. My name is Oliver Turner. I'm the Executive Vice President of Corporate Development for Karora Resources. We are a Western Australian domiciled gold producer, producing about 120 to 135,000 ounces of gold this year, increasing production to 200,000 ounces by 2024. We've got 2 mills, 3 mines, and a really interesting nickel byproduct credit at the same time, generating a lot of cash flow.
I like that. 2 mills, 3 mines. I like it. Ollie, thanks for coming on. Appreciate you making the time here. I know you guys are running around like crazy at the moment. You just put out the kind of third quarter numbers, strong record production numbers, AISC coming down. It's all easy breezy at the moment, isn't it?
Yeah, I wish it were easy breezy with some excellent execution by the operations team. Obviously, nobody's a stranger to the current operating environment and inflationary cost environment, but what I'm extremely proud to say is that despite all of those hurdles over the course of this year, the team has just executed like we have over the last 2.5 years, operationally bringing those costs down, delivering ounces, delivering into that growth plan that we outlined about 1.5 years ago now, doing an outstanding job. And record is right. We achieved a lot of records in this quarter. Very proud of it, and certainly more to come over the next year.
Right. So how do you continue to deliver? Like I know I'm sort of joking about how easy it is. It is not. I've got CEOs coming on, companies coming on the show. In fact, one last week just said, I can't do this. I am so concerned about the rising costs here. I want to have a conversation about how do I change this into a negative story. And the truth is, it is what it is, right? And we've got other guys coming on talking about putting out economic studies. No one cares. It is a difficult environment for gold. You're getting pressure coming down from gold price. You're getting costs rising. What do you do about it?
Yeah, no, it's definitely a challenging environment for a lot of projects out there, particularly the unfinanced developers. It's very, very challenging for them. We're in the fortunate position, obviously, of having not one, but actually 3 operating centers that are delivering profitable gold ounces to these 2 centralized mills that I talked about. But all of this comes down to operational strategy and operational readiness, and ultimately the workforce that you have on the ground. We were over the last 2 years, one of the sort of rising stars in Western Australia. We were able to attract a top tier talent at the operations. We all remember the stories you and I were chatting about in 2020, where we were attacking all of those cost levers, bringing costs down, and basically future-proofing this business for an environment where gold prices were retracing. I don't think anybody envisioned the inflationary environment we'd have squeezing costs from the bottom up, but we certainly were positioning ourselves to have that kind of long-term durability. So operational readiness, the right people on the ground. I'm really excited to talk about one of our new additions on the team, our new Chief Operating Officer, Bevan Jones, at some point today. He's done an outstanding job already, recently in the seat. But we also have, as I mentioned in the introduction, another lever we can pull with this nickel byproduct credit as we move forward, which provides us a little bit more insulation from those squeezes in gold price.
Okay, well, let's talk about Bevan, because the market is super tough at the moment. There's only so far you can squeeze cost reduction exercises internally, right? Before you start cutting corners, which are not good. You're going to be reliant on gold price recovering, but all precious metal companies in the same boat at the moment, unless you can get more ounces out of the ground. And I guess that's where Bevan comes in.
Yeah, absolutely. So Bevan's basically been in the chair now for about 6 or 7 weeks in Western Australia. One of the huge advantages that we have with Bevan joining, Bevan Jones is his full name. He comes from the St. Ives mine, which is literally across the fence, a Goldfields operated mine, one of the largest mines in their portfolio. And I say that on purpose. He is a big mine, big operator guy with plenty of experience in managing large, complicated operations. Some of the things that he accomplished at St. Ives next door, he increased production by about 20 to 30%. He reduced all-in costs, not all-in sustaining costs, but all-in costs, encapsulating all capital, all of your spends, by about 25%. All of this while improving the safety record of that operation over the last 4 years. So he brings in a new level of efficiency and organizational optimization and strategy going forward. So he's coming in with the growth plan that we laid out to the market, but he's adding another level of capability and strategy and way of thinking about how we execute on this plan, particularly given the current environment with those increases in cost that we're seeing. The last thing, and this is very, very important, is, as we talked about with Graham, who did an unbelievable job over the last 2 years, very happily be retired. We're quite happy for him there. We continue to get his strategic input, but he brings with him a large network. Right? When you have strong operators and strong leaders, they typically bring the best people with them as they switch from company to company, and we'll have that benefit with Bevan as well. So Graham brought in an excellent team. Bevan's going to layer on top of that and bring in even better operators that are able to navigate these sort of troubled waters that everybody's experiencing right now.
Right, like you guys have delivered since we met in September 2019. You continue to deliver quarter over quarter. So the market can't ask for anything more than that. But obviously, it's got its own spasms and problems out there at the moment, which you need to work your way through. But what does someone like Bevan and where he's come from do for how you manage things internally? Because you've been very good at kind of banging out mineral resource estimates. The technical reports, not so much, right? You've got multiple assets that you're going after, three mines and more targets on top of that. How do you kind of bring all of that together, manage the gold component, whilst also trying to extricate as much value as possible from the nickel component, because it's a much more complex, so it's a longer, harder process to kind of get that out of the ground and do that, or get as much of it out of the ground before your gold runs out. So how does all that being looked at?
Yeah. So, we did put out the PEA study on the nickel a couple months back, and hopefully your listeners and your viewers have gone through that. Some phenomenal numbers out there in that PEA. Extremely low upfront capital. It's that same narrative that we've been saying for years at Beta Hunt, where you get to use the same infrastructure to access both the gold and the nickel at the same time. They're immediately adjacent to each other. So what Bevan brings in is first and foremost, look, we've got all of this noise from the outside, right? We've got inflationary pressures. We've got, as with everybody, retention issues. Skilled labor is extremely tight to get anywhere in the world. It doesn't matter where you are. So he improves that retention and that attraction talent. At the same time, he makes sure that the team is squarely focused on delivering that 200,000 ounces per year by 2024, as we stated in our growth plan. And you can put out a plan, but to execute it is very, very challenging. So we're making sure we don't lose that focus. Concurrently, what he's able to bring in is another basically projects team that is focused on delivering this nickel PEA. So when it comes to delivering that nickel, what our objective is, and as we laid out in the PEA, it's going to be about a year's worth of minor development that goes into that. And you'll really start to see those nickel tons kick up in 2024, actually. So it's a lot sooner than people think. Here we are, we're about a month and a half away from the end of 2022. So you could be about 14 months away from those elevated nickel tonnages coming out of Beta Hunt. Now, what could we be seeing in 2024? When you combine the remnant nickel mining, which we've been doing for a couple of years now, smaller scale mining, more labor intensive, higher cost, but nevertheless kind of gives us about $20 to $30 an ounce in byproduct credits. If you combine that with the new output from the nickel PEA zone, which is called the Gamma Zone, you could be seeing about 2,000 nickel tons coming out of that second decline by 2024, 2025. Now, what does that do from a cost basis? Right, at very, very conservative nickel prices, $19,000 a ton, and I'm sure we all agree that nickel prices are probably going to be trending up over the next couple of years, given all the shortages, particularly when it comes to nickel sulfide material. We will see those 2,000 nickel tons translate into north of $100 in byproduct credits, if not more. Right, so that provides incredible margin protection. Dare I say it, even margin expansion, particularly if some of these inflationary pressures ease. So that's really, really important for us. So we've got a projects level team executing on that, a projects level team executing on the gold expansion study. And I do think it's actually probably worth a little bit of an update of what's going on there so you can understand some of these moving parts. Because as you mentioned, there's a couple things going on, and we'll try to sort of simplify this to give you a bit of a roadmap of what's going to happen over those next 14 months. So we have the single decline at Beta Hunt, about 1 million tons per annum coming out of that. Although, if you look at our last month, we were very proud to note that we did about 100,000 tons a month out of one decline. Annualize that, about 1.2, right? So can we go bigger than 1 million tons per annum? Potentially. So that's one decline. The second decline is actually tracking ahead of schedule. We are on track to complete that in the first quarter of next year. That will double the capacity, the trucking capacity from underground at Beta Hunt to 2 million tons per annum by the end of 2023, early 2024. In addition, as we've demonstrated with the throughput rates we put through so far, we will be able to truck nickel ore and gold ore out of those two declines at that 2 million ton plus per annum mark. and that will allow us to deliver into this. So as we complete that decline in the first quarter, the next step is, in order to put more equipment underground, you need more ventilation. You're always restricted by how much ventilation you have. So the next phase is putting in a new ventilation shaft. That goes up, scheduled to be completed somewhere around mid-year to the beginning of the third quarter. Once that's in, we can start to get some additional development in place for those additional gold stopes, and then the nickel development really kicks into high gear. And by high gear, I mean a whopping $7 million is spent in year one. I say that with a smile on my face, because tell me a nickel project in the world where your initial capital to bring a nickel project on is $7 million. Very, very low. And it all comes together in 24, 25 to really kick up your gold ounces and your nickel production at the same time. So all that needs to be managed by someone that's managed big operations with projects going on at the same time as operational delivery. And Bevan brings in a wealth of knowledge and experience in that area.
Right. Okay. The flip side of this, the small capex component is the fact that, you know, I wonder how much of the nickel feed will be paid for as a percentage in a process like that. And as you say, with the kind of second decline, you know, if you're going in on the sort of current ore blocks, or you're looking at, you know, going after new ore blocks, which will require substantial underground development, you got to work out, you got to put a number on that, and then kind of work out the best way to play that. So I'm sort of intrigued to see what's going to come out of the next few months in terms of the studies, but also in terms of the way that Bevan thinks that you guys should approach this. Yeah,
no, it's a fair point. I mean, on the capital requirement side, take a look at our 3-year guidance. It's been out there for a year and a half. In 2023, we've got our growth capital and sustaining capital assumptions in there. That incorporates the additional development you need to bring on those additional ore blocks in the gold space. When it comes to the nickel, we put that PEA out, so you have that $7 million that gets added next year. And once basically that's put in place, I mean, you have to have development in place in order to mine ore blocks. You can't do it without that. But once that's in place, we'll be stoping from additional stopes, both in gold and in nickel, and enjoying the free cash flow that comes out of the back of that for many years to come.
But are you going to be like giving a little bit more guidance? Are you going to be issuing sort of more technical reports, or is it a case of, as you have done so far, which is really just a case of feeling your way through the multiple assets that you've got? For instance, like, you know, I don't think, you know, like Spargos doesn't have a technical report, but you're finding the answers, you're finding the grade there. So again, is it kind of, with Bevan, say we need to kind of step up our kind of professionalism here? And I know you've done well so far, but what, in terms of that step up, what does that look like?
Interesting comment. When it comes to expanding production in an existing asset, we actually did 3 internal studies when we were looking at the expansion of throughput at Beta Hunt. We evaluated a twin decline scenario, which is what we selected. We evaluated a shaft scenario, which we obviously did not select, and we evaluated a conveyor going up that second decline, which obviously we did not select as well due to flexibility issues. So the second decline was selected based on that internal work, and then we used that as the basis for that 3-year guidance that we put out to the market. Now, when it comes to the nickel study, what's really quite interesting at Beta Hunt is you have 35 years of nickel production under your belt there. You have nickel mining costs that we're doing right now, today. Actual cost, real contractors. We can tell you what the cost was tomorrow for that group in terms of doing their mining. So the input data that's going into that PEA is as good as it gets because it came from yesterday. So when it comes to forecasting what future costs are going to be from a study perspective, we will update our input assumptions as we move forward into next year, reprice in terms of, have things moved since we put out that study in the third quarter of 2022. But do we need to go into a full feasibility for a project that you can literally touch the face right now? Interesting, right? I mean, that would just only do one thing. It would delay your ability to get in there quickly. You'd obviously spend time and energy working on that study. Why not, if you're there and you can mine it with the same infrastructure, not additional development, the same infrastructure that you're going to be mining the gold from anyways, why not start mining and execute? Obviously, we're going to have we have a reserve model, and we'll mine to that reserve model and move forward that way. So it's a little bit different when you're in an operating mine versus starting up something new. When it comes to something like Spargos is just a quick reminder here, we bought that for a whopping $4.5 million Australian in 2020. We've extracted over 40,000 ounces from Spargos already. It has paid for itself time and time again, multiple times over. We've generated some very, very good cash out of Spargos. Now, what's interesting about Spargos, and where study work does come into play, is Spargos was essentially a restart of a former underground mine. What we're going to be doing now, and we're evaluating this internally, is the underground potential of Spargos. Are we going to go underground there? There's some gangbusters drill results at depth. You guys remember we had those 19 grams over 20 meters, an ounce per ton over 20 meters, which was phenomenal. We absolutely think there's underground potential there. We're analyzing that, and that's something you can expect a technical report to be wrapped around if we make the go-ahead decision there. So when it comes to new projects, we will. When it comes to operating an operating mine and expanding an operating mine, you got the face right there. You need a very, very tightly controlled resource model, but we also have a very long history of mining gold at Beta Hunt. These shear zones are very predictable. We've added a ton of ounces. We've mined a bunch of those ounces already. So basically working off a lot of experience when it comes to that asset, and I think it's paid dividends over the course of the last 2 years.
Right. Okay, so it's kind of attitude of, trust us, it's economic. We've been there and we've done it, and we continue to deliver quarter over quarter. And to a very meaningful level, I totally like that. I have no problem with that, because the number I care about is the number of ounces which you say you're going to deliver. Is that going up? Is your margin improving? And what's that doing to your share price? So let's look at the share price. Your share price has been as high as, nearly 750, I think, earlier this year. Here we are down at 330. You've been beaten up good, just like everyone else. And do you think that if you were presenting the information, the technical information, people would go, well, these guys are doing things properly, and a bit less of the trust us, we've done everything we've said we would so far, that would look any different?
It's interesting. You come back to your first comment earlier where you say that, studies are going out into the market right now and nobody cares. So is it worth putting that work out right now and pausing what we're doing? Probably not. When we have accounts, and we're going to have analyst site tours next year for the first time since COVID, which we're very, very excited about. That's what they get paid for. That's their job. These are mining engineers and geologists that come in. They'll take a look at the asset. They'll take a look at our resource and reserve model to see how much of those resources they think are going to be converted into reserves based on past conversion rates. Guess what? We have years and years of conversion history. And then they'll forecast basically how long they think this mine goes for. So that's exactly what those institutional grade investors do. And that's why they put tens of millions, if sometimes not hundreds of millions of dollars to work in some of these stories. So they have to do that level of work for it. So that's very, very important. When it comes to the share price, it's been a violent pullback for everyone in the space. There's absolutely no doubt about that. We talk about valuations if you want, and maybe what's not priced into the stock. In terms of what you're getting basically for.
Well, let's go there, because I think that's really, really important, because I think some people will have cycled into this position, and not many will cycle out. Like, I've interviewed quite a few of them whose CEOs are genuinely nervous. They're either cash constrained or they're marginal projects which are just not going to be able to recover, certainly not at these gold prices, and definitely not with these increased sustained influence of inflation, right? So it's important for me as an investor to understand which company is going to be around to cycle out of this. You're producing cash. You're getting squeezed like everyone else there, because margins are being compressed somewhat, but you are producing cash, puts you in an unenviable position of making decisions which you are in control of. So why is this still a growth story? Why are you versus some of your peers going to come out of here in better shape than others?
Yeah, you sort of hit the nail on the head there with that one comment. We are in an enviable position of generating cash every single quarter, deciding to allocate dollars to new projects, to new expansions, to new studies. This isn't a survival mode. This is a full tilt ahead, execute and deliver on doubling our gold production over the course of the next 2 years. So what the story isn't, we're going to do 120 to 135,000 ounces this year. We're not going to flatline that for the next 5 years. We are increasing gold production to 200,000 ounces per year. That is a very, very large increase. via the capital that we've been deploying into this asset over the course of the last year. So we are generating cash, we are maintaining, and eventually we'll be expanding margins, and we are delivering into that growth plan, not just sitting here and trying to survive until things get better.
Show me. Okay. Let's dig into this. This is very important. We've seen a few companies like Pure Gold. They made a lot of claims. Hasn't gone so well for them, right? Yep. We've seen some really expensive acquisitions as people seek the ounces, not the margins, the ounces. Big one going through at the moment. I mean, some big numbers there on the Yamana. We'll call it competitive tension that they've managed to get in place at the moment. People are paying a lot of dollars for those ounces. Why are you going to hit 200,000 ounces? Why is the way that you're going about it the best way to do it in terms of return on capital invested?
Yeah, I mean, so a couple of points to touch on there. When it comes to some of the unfortunate events that we've seen in the mining sector over the course of the last year that are predominantly CapEx related, right? I mean, one thing for everybody to remember, but this is why you hire competent management teams, mining is hard. Mining is very, very hard. It is technically challenging. No two assets in the world are the same. It is very, very challenging to do. So even when times are good, it's tricky to execute on those plans. So that's the first thing. When it comes to M&A, the honest truth is, in terms of major ounce replacement and in terms of replacing your reserve life, so if you're a senior gold producer, you're basically valued on your reserve life. You continuously need to replenish that. The number of major new discoveries that we've seen since the year 2000 have absolutely plummeted. It's suffice to say, and I'm not trying to be coy here, the easy stuff has been found. In the good jurisdictions has been found. People are going to have to venture into trickier and trickier jurisdictions. Again, one of the benefits for us, we're in Western Australia, but in trickier and trickier jurisdictions to find these large deposits, right? And there's a number of them that you interview and know very, very well. So it's harder and harder to find those ounces, which means you basically need to buy those ounces. And they're not purchasing these ounces for project metrics today. They're purchasing these ounces because this is a cyclical industry. Margins do contract and expand. Gold prices move in all sorts of directions. So they're basically buying these things, number one, because they need the ounces, number two, because they know that times will get better at some point in time. So that's the commentary on that. When it comes to us, our sort of goal here when we stepped into this company in mid-2019 was we saw an enormous amount of potential in the scale and size of the Beta Hunt system. And we haven't even talked about all of the Higginsville stuff, right, in terms of exploration there. But we are focused as a junior gold producer on one asset at a time, make sure we execute on that, and we'll expand our purview after that. So we saw tremendous potential there, right? But we knew there's a lot of hair on it and a lot of things that needed to be unlocked, which is what we've done over the last 2.5 years. We know that the number of, call it 200 to 250,000 ounces, single asset sort of producers out there in low risk jurisdictions, and even ones that actually have a pretty incredible byproduct credit, can probably be counted on two hands. We are one of them. We're the one of them that's right in the backyard of the largest mining jurisdiction in all of Australia. So suffice to say, there's a lot of companies that are following us with keen interest, and that is part of our job, is to continue to execute on that plan, keep our heads down. Inbound interest has come in over the last couple of years. It always is there. People tracking our progress, seeing what we're doing. What are you going to do next? Okay, we're going to go watch them for a couple of quarters. Can they do it? And we just deliver, and that's our job. That's why we have the team that we do, and this is going to be a 200,000 ounce a year company here in the next year and a half, and then we'll look at the next challenge. How do we grow from there? How do we expand that asset even further? Are there other assets in our portfolio that we can then exploit? Right, that is our job as a management team, and given the scale and the size of our company, I mean, one of the things I don't think too many people know, there's about 600 people in Karora, from top to bottom, including all of our miners, contractors, people on site, people in offices. It is not a large company, but we've got a large company mindset in terms of how we've executed and where we're going to be taking this asset. Then the last thing I'll say about Beta Hunt as well, the other thing that larger companies look for is how big can this thing be? How long can this reserve and resource life go for? This is an asset that, and I'm not saying this in a joking way, our chief geologist says this is a multi-generational asset. It already has been, and it will be. This thing will be mining for long after you and I are probably done these interviews. So it's a tremendous asset to own, and we're trying to get it up to that 200,000 units a year mark that gets everybody interested.
And then what?
Well, then we'll try and get it to 250, 300, but I'm not saying that about beta hunt. That is not guidance. We'll see what we can do. It's a big efficiency game. Obviously, even small bumps in grade at these tonnages make enormous differences in your bottom line and in your ounce production, but lots of work still to be done there.